Once upon a time, retirement planning was simple. You would retire, then cash out of the stock market, leave the risk behind, and move into bonds paying 6 to 8%. Those days are long gone. If you live in Phoenix and are retiring soon, you know this dilemma only too well. Today, you're lucky to get 2% on a quality bond. The solution? Do what smart, logical retirees are doing. They're making the move for their IRA rollover to the next generation of principal-protected, low-cost, high-income annuities through IQ Wealth Management in Scottsdale. Best-selling author, leading financial advisor, and the host of Mastering Money on Money Radio, Steve Jurich, is the trusted advisor that you are looking for. Let's listen in on a recent broadcast of his popular show, Mastering Money. At any point throughout, you can visit our website by clicking the little circle with the eye in the top right corner.
Learning the language of annuities was something that many people never thought they would be doing. But as interest rates on traditional fixed income investments like bonds and CDs have fallen into the basement, and even below the basement, annuities have taken on increasing importance in the financial planning affairs of many. The demand for principal-protected, low-cost, high-income annuities is very strong. Capped or uncapped, hypothetical illustration or guaranteed stepped-up increases, simple interest or compound interest, long-term care rider or no long-term care rider, inflation-adjusted income or permanent level income, joint income or single income, bonus or no bonus. What are sub-account charges? Which annuities have sub-accounts and sub-account charges, and which ones don't? Which annuities risk the owner's money in the market, and which ones don't? Which annuities protect principal against all market declines, and which ones only protect the annuity's income value? Many retirees are tired of paying fees to lose money, and they're tired of trying to turn their IRA rollover into permanent income with things like bond funds and bond ladders. They want something more reliable. They want a financial vehicle that will deliver reliable income while safeguarding their principal. If you're looking to protect what you've saved all these years, yet you want a retirement income that doesn't rely on skill or luck, then it's probably time to get familiar with the language of annuities. It isn't that hard, but you will need to leave your preconceived notions at the door, and you'll need to understand that searching the internet will wind you up right back where you are now, with questions looking for honest advice, accurate comparisons, expert answers, and experienced guidance. Certified income specialist Steve Jurich spends his professional time modeling income and growth portfolios for retiring engineers, healthcare professionals, teachers, business owners, technicians, attorneys, and other professionals. Steve is a genuine annuity authority, a certified annuity specialist, and he's author of the best-selling book, Smart is the New Rich. Steve heads IQ Wealth Advisory, LLC in Scottsdale, a registered investment advisor with asset custodian Fidelity Institutional. His comments have been seen on Bloomberg MarketWatch and CNBC.com. Steve, how are you today?
Sinclair, doing just great today. How are you doing?
Doing good.
Good.
Steve, a recent Barron's article by Randall Forsyth pointed out that owners of bank accounts and money markets, a.k.a. they're sitting in cash,
right,
have lost out on over $500 billion in interest gains over the past 5 years alone.
Right. Mm-hmm.
As interest rates have just dropped from the 5 and 6 range to the 0 and 1% range.
Right. Uh-huh.
That's money that would have been in their pockets, but now it's nowhere.
It's nowhere, yeah.
Sitting in cash costs money, and costs more the longer you do it.
Right.
So annuities that can grow future lifetime income at rates of 5, 6, and 7% really are more relevant than ever.
Well, they really are. There's just nowhere to go out and get a safe, 5, 6, 7%. The fact of the matter is that's what people want. I still get emails, hey, Steve, outside of annuities, where else? I need to get a guaranteed income stream somewhere in that 6 or 7% range. I'll settle for 6 or 7, but I need it guaranteed, and I need it liquid. And I'm like thinking to myself, oh, yeah?
Okay.
Don't we all?
Yeah.
Well, why stop at 6 or 7? Listen, I always say, I know what people want. They want 20% returns, 100% liquidity,
Yeah.
right, and 0% risk. And the fact is
That sounds great.
doesn't it, though? It really does.
What fairy tale can I find that in?
There gets just to be something called asset allocation that gets to be the most important thing you can do, and you don't have much time to do it. Like you said, 5 years can go by so quickly.
Yeah.
And you've given up on a lot of growth that you could have had, for instance, in a fixed index annuity with an income rider that would have been growing your income for the future at 5, 6, or 7% on a guaranteed basis. And the fact is that you start thinking, hey, what have I really missed out? You've missed out on the idea of having a lifetime guaranteed income that requires no skill or luck, that even if you don't get out of bed in the morning for the rest of your days, will continue to pay that $1,000, $2,000, $3,000, or $4,000 a month from now on for you and your spouse. Your alternative, keep sitting in cash or keep relying on things like bond funds and bond ladders. It's not looking too bright with those types of assets right now.
Well, as you say, annuities really are more relevant than ever. Mm-hmm. So what do you say we start reviewing the language of annuities today? Let's see how far we can get.
Sure, let's do it.
First order of business, I think, would be a quick review, and this is really for first-time listeners, maybe a refresher course for listeners who have been with us for a while. Let's talk about the 4 kinds of annuities.
Very good. The first thing you need to know, because it's important when you're on the internet or you're listening to the radio or watching TV and someone's talking about annuities, if they're talking about expensive, you need to know what they're talking about. If they're talking about that the insurance company keeps your money when you die, you need to know what they're talking about. So there are 4 kinds of annuities: immediate, variable, fixed, and fixed index. Those are the 4 kinds. Now, you'll hear about deferred income annuities. Well, those are really in the immediate annuity family because you give up access to your lump sum. Okay. So you have if you're okay with turning over all of your money to the insurance company and them keeping it when you die, then you're good with an immediate annuity. Otherwise, or a deferred income annuity.
That just turns a lump sum of money into a stream of income.
Period.
Right?
Yeah.
That's it.
That's right. A variable annuity, you keep access to your money. You can see it on the screen. You can log in and see what's happening, but sometimes you won't like what's happening, like if the market is declining and as you start to see the fees coming out. And when you hear about people saying expensive, annuities are expensive, they're talking about variable annuities. Even the Vanguard variable annuity with an income rider has a 1.55% fee on it, basically for that income rider. Then there's fixed. And
just to be clear, the variable annuity is going to invest in equities and bonds.
That's right. The same, really not equities. They're going to invest in mutual funds.
Mutual funds.
Yes, that's what they have. It's
mutual funds that would invest in equities.
That's correct. They're sub-accounts. You're going to see the same names. That's why people buy them. People love familiarity when they get a little scared and they say, well, I don't know how much I'm going to really want to get to know about this whole annuity thing. I don't know how really smart I want to become. I don't like them anyway. And so you'll start seeing familiar names. You'll see the insurance company you recognize, and you see mutual funds you recognize, and you say, well, at least I've heard of it.
Well, but if you're investing in equity mutual funds and bond funds, there's a risk there, isn't it? You can lose money, can't you?
Of course. You've got the risk of the market. You've got with stock mutual funds, of course, you've got the very thing you're trying to get away from, which is the risk of the market. You're perceiving that at your current age and where you're going to be in 5, 10, 15 years, you need some of your money sequestered away from the risk of the market. It only makes sense. no matter what you do with it. And that's why people go to cash. They're sitting there saying, well, I don't know what I'm going to do with my money, but I know what I'm not going to do. I'm not going to lose.
Okay.
And so the fact is that variable annuities, you still will have your principal at risk. And, of course, the reason why people buy variable annuities is it's the pitch of familiarity backed up by income. And you can get income from a variable annuity, even if the principal goes to zero, which it probably will. Once you start taking that income out, you'll be lucky if that principal lasts 12 or 15 years.
So essentially, at some point, if that goes down, you could be turning a variable annuity into an immediate.
Very good. Exactly.
Okay.
That's what happens with a variable annuity. Basically, all of them will eventually turn into an immediate annuity. But the fact is that variable annuities are in a hurry to get there. I mean, you're talking about 3 to 4% per year in fees. Now, that's what really throws me when someone who their entire investment life has studied the fees on mutual funds or ETFs, and they buy the ones with the lowest fees. Then you jump into a variable annuity with 3 to 4% fees and actually believe the salesperson when they say, hey, you're going to make money over time and get all these income step-ups. Oh, really? Ask John Bogle how it works if you have 4% a year in
Markets
fees.
are going to have to do remarkably well.
Yeah, because if in down times that 4% exacerbates the loss, and in up times it's shaving the top off of it.
It's like a double whammy when the markets are going down.
If you would like to retire and stay retired, click the link to hear the rest of the show or to visit the website and learn more about making the move to the next generation of principal-protected, low-cost, high-income annuities through IQ Wealth Management in Scottsdale. Click the link now.